Hi, my name is Yasmine and today I will be discussing value creation, corporate governance, and socially responsible investment stocks with reference to my chosen company, Marks& and Spencer. Marks& and Spencer is a British multinational retailer selling clothing, beauty, home, and food products in Europe, Asia, and the Middle East. It is listed on the FTSE 250 and has a market capitalization of £2.34 billion. One of its major competitors is Next plc. Starting by discussing value creation, companies create value to survive and succeed. Kohler et al. State that companies are judged by their ability to create value and the amount they create. Companies create value by investing capital to generate future cash flows at a rate exceeding the cost of capital. Value can be created through growth in revenue, funding projects, and ensuring an optimum capital structure of debt and equity. For Marks& and Spencer, we can see how they are creating value through upskilling workers, entering a joint venture to increase sales, investing in environmental, social and governance, also known as ESG, initiatives, and scaling back on products which were not resulting in value creation.
Who is value being created for?
There are two opposing schools of thought on this. The traditional shareholder theory states that companies create value for owners. An agency problem arises due to a separation between the owners and the managers. The stakeholder theory, on the other hand, states that companies also consider the wider external stakeholders. Here, companies need to make trade-offs between different demands. Looking at the company's annual report, we see how the board considers both shareholders and stakeholders in its decision-making. The board also emphasizes driving value creation over the longer term. This seems to align with Jensen's enlightened stakeholder theory. The company recognizes that value can be created when stakeholder needs are considered within its business decisions, and that certain trade-offs must be made to achieve long-term value. This aligns with Queen, who stated that companies need to satisfy stakeholders to create long-term shareholder value. Specifically focusing on the shareholders which provide the company with capital, Marks and Spencer holds numerous interactions with its shareholders, and it implies wanting to return value to its owners by allocating capital for value creation and paying regular dividends. However, the company has not paid out dividends in the last 2 years, citing economic turmoil. Here we consider how firms are usually reluctant to cut dividends due to the negative message this conveys. Furthermore, Sung and Urusha state that a company's current stock price is determined by future dividends. Therefore, share prices may go down if no future dividends are expected.
What does this mean for Marks and Spencer? And how does it transpire into value creation?
So, looking at financial performance measures relating to firm value, indicators such as return on capital employed, earnings per share, and return on assets reveal that the company is falling behind on all measures when compared to its competitor Next, especially EPS and ROA. For the EPS, we can see how Marks & Spencer has diluted earnings as it has 1.96 billion outstanding shares. On the other hand, Next is reporting record EPS due to having bought back shares in 2022, and it intends to do so in subsequent years. Next also reported a higher profit. With respect to ROA, the company has a significant amount of assets, but a lower return compared to Next, indicating that Marks & Spencer is not utilizing its assets efficiently enough. A company's performance can also be assessed through share prices. Similar to the financial performance measures, it appears that Next has consistently outperformed Marks & Spencer. According to the annual report, Next has distributed a dividend, proposed one for the following year, and is also planning to continue distributing dividends. On the other hand, Marks & Spencer's dividend policy has been inconsistent, and there is no forecasted dividend. Value creation can also be measured using net present value and real options, where investments generating a positive value should be accepted. I have prepared an example of this using Marks & Spencer with illustrative figures for the returns. The company has decided to open new stores, and in my scenario I consider opening one of the new proposed stores to assess whether the project should be expanded. For the real options, I applied a discount rate of 10% and forecasted a 40% positive outlook due to the economic forecast for the UK. Under both options, we can see that the investment would lead to a positive return. Moving on to corporate governance. Corporate governance is the system by which companies are directed and controlled, and the board of directors are responsible for this. Marks and Spencer's board structure is composed of a unitary board, where executive and independent directors are responsible for advising and monitoring the company. 7 of the 9 board members are independent non-executive directors, or ENIDs. Next also has a similar structure, however half the board members are ENIDs, representing less independence. The ENIDs conduct the chairman's appraisal, reflecting an independent evaluation. The CEO and chairman are separate, allowing the board's monitoring capability to be enhanced. This role separation is set out within the UK's Corporate Governance Code. A balanced board in terms of gender allows for competitive advantage. Here we see how women make up 45% of the Marks and Spencer's board. However, women only make up 34.5% combined executive committee and direct reports, falling behind next. Board committees, executive committees, and senior leadership forums report to the board and are tasked with different assignments. For board committees, there is the audit, remuneration, nomination, and ESG committees. The nomination committee in particular is responsible for ensuring that the company's governance can deliver shareholder value over the long term. Through assessing the skills and experiences required on the board, the company can create a board with a competitive advantage. With respect to the executive committee, this executes the strategy, whilst the senior leadership forums support governing bodies and are responsible for key trading and operational matters. A different board structure to this is the two-tiered model utilized in continental Europe, where there is a supervisory board and a management board. The supervisory board oversees the board's activities, and the management board manages the firm's operations.
Is one model better than the other?
When considering value creation, from Denital's research it appears that company structure does not have much effect on the company's value. The structure may be also prescribed by the legislation of the country, leaving little choice to the company.
How can management interests be further aligned with shareholder interests?
So, through the compensation structure, managers' personal wealth can be tied to company share performance, so that managers are incentivized to consider long-run performance of the firm. To allow managers to focus on value-creating objectives, Marks and Spencer have implemented a share-based payments with vesting period, an annual bonus scheme based on profits, and a performance share plan based on long-term goals and value creation measurements. This aligns with Queen's research on how enlightened stakeholder theory can be achieved by focusing on financial and non-financial performance indicators. The director's remuneration is approved during the AGM, aligned with the UK's say-on-pay regime. Furthermore, it appears that the company's CEO pay, in comparison to the rest of the company's employees, is lower than next. Here one can consider Panetal's findings, which suggest that within firm pay dispersions negatively affect firm value and consumer perspective. Therefore, Marks and Spencer are better positioned in terms of this. However, the CEO still benefited from a 1% salary increase in 2022, which seems unfair in light of no previous or forecasted dividend distribution. Indeed, the company was featured in several news articles due to this.
How is the company actually performing in terms of its corporate governance?
So, despite considering stakeholders and shareholders in their decision making, Marks and Spencer have still been involved in numerous scandals as seen in the slide. However, it is not a black and white situation, and they have signed an anti-slavery charter, are selling their RSPCA assured food items, and ultimately have an ESG Plan A to become a net zero business across their operations and the entire value chain by 2040. Therefore, there has been an attempt at rectifying their scandals. Moving on to social responsible investment, or SRI. SRI is a critical component of corporate governance, where investors consider ethical, social, and environmental performance. Closely linked to SRI is corporate social responsibility, which encompasses a business responsibility to the economic, legal, and ethical expectations set by society. Companies should therefore make ethical decisions through utilizing decision-making tools such as Tucker's 5-question model. From an investor's perspective, literature shows that investors do not react well to negative CSR news as it is linked to loss of money. For a company suffering from negative CSR news, Its efforts to offset such news usually leads to stock price increase. Therefore, Marks and Spencer management should have worked on offsetting the negative CSR news seen on previous slides to improve its share price. From Marks and Spencer's perspective, the company has promoted healthy food and less waste to its consumers, been a part of schemes supporting underrepresented groups and young adults, and committed to a responsible supply chain and recycled packaging. Despite its efforts, its ESG ratings have been unstable, and it has average ratings by Morningstar and Bloomberg. Recently, it has even been removed from Dow Jones's Sustainability Europe Index. In comparison, Next has consistently been ranked above Marks and Spencer in Bloomberg's ESG score, and it has been performing better seen throughout the presentation. This shows that Marks and Spencer needs to reassess its approach to ESG and consider what its competitors are doing. We also need to evaluate whether the market is reflecting their commitments or whether they need to lead the market to understand the implications of their policies.
How does SRI affect investment decisions?
So, the literature is divided on this. Some researchers say that SRI investments are a branding exercise and investors are not willing to accept suboptimal performance in the name of CSR. On the other hand, others say that SRI portfolios perform better than market indices and investors will not be disadvantaged in investing in such companies. Due to the growing importance of SRI, this debate will not stop here. However, recent literature is revealing improved returns when investing in SRI portfolios. From a company perspective, this aligns with Next outperforming Marks and Spencer. Ultimately, BlackRock stated that investors are shifting their investment preferences towards sustainability. Therefore, companies should engage in CSR to profit from the trend and attract additional capital flows. This will allow companies to benefit from higher valuations. Finally, with respect to expansion-related strategic decisions, after considering the previous three themes, I have prepared a company SWOT analysis. The company has opportunities for further global expansion and investment in the online platform, but it should pay attention to its competitors and the public's discretionary spending money. I would therefore make the following recommendations. First of all, the company should advertise its membership experience. From company research, it appears that Marks & Spencer has recently relaunched its membership experience. The company needs to advertise this more to enroll more members, which in turn generates more sales and ultimately creates value. Secondly, the company should invest further into the online platform and focus on selling food through it. Since a deteriorating retail outlook is being forecasted for 2023, Marks & Spencer should shift its focus to selling food over clothing through the online platform. Thirdly, the company should continue committing to its sustainability plan and report on milestones to improve its ESG score, and also try to avoid further downgrades which would negatively affect its shares. Finally, the company should focus more on the global market to generate revenue. It heavily depends on the UK market and generates over 90% of its revenue from it. It already operates in regions outside the UK, therefore it should further invest in these markets to generate new value. Ultimately, the company should ensure that any expansion decisions taken are aligned with its strategic objectives and ESG commitments. Thank you a lot for your time.